We assume guilt triggers physiological panic, but your prefrontal cortex can physically rewire to suppress the amygdala, allowing a parent to sustain decades of corporate embezzlement without biological stress. This is the story of the Miller family. Names and specific corporate identifiers have been changed for privacy, but the financial records remain exactly as they were filed. By the end of this audit, we would realize that the true cost of our financial stability was not measured in dollars, but in a legal concept known as willful blindness. For 25 years, my siblings and I operated under a shared, comfortable fiction. We believed our family's financial foundation was built on the quiet genius of our father, Arthur. He was a mid-level supply chain director for a regional pharmaceutical distributor. He drove a 10-year-old sedan, wore off-the-rack suits, and never spoke about his investments. Yet, every month, a silent stipend arrived. It began in October 1998. A deposit of $4,500. It was labeled simply as a distribution. The following month, another $4,500. This was not a one-time windfall. This was a structural anomaly that persisted for 300 consecutive months. Over a quarter of a century, that silent stipend totaled more than $1.3 million. It paid for my undergraduate tuition at Northwestern. It funded my brother's medical school loans. It provided the down payment for my sister's first home in Seattle. When we asked our father about the source, he offered a vague, rehearsed explanation. He claimed it was the return on an early angel investment he had made in a logistics startup during the late 90s. He said the company had been absorbed into a larger holding firm, and the monthly payouts were his structured dividends. We accepted this. We did not ask for the K-1 forms. We did not ask for the stock certificates. We simply accepted the capital, allowing it to insulate us from the economic realities our peers were facing. My father passed away in October of last year. A sudden myocardial infarction. He was 68. As the executor of his estate, my first task was a routine probate audit. I hired a forensic accounting firm to consolidate his assets, liquidate his modest retirement accounts, and prepare the final tax filings. I expected a straightforward process. A mid-level corporate manager with a modest 401k and a paid-off mortgage. But on a Tuesday morning in late November, the lead accountant, a meticulous woman named Sarah, called me into her office. She placed a single sheet of paper on the desk. It was a cash flow analysis of my father's primary checking account. She pointed to the bottom line. The $4,500 deposit had cleared 3 days after his death. The stipend was still active. Sarah explained that if this was a dividend from an acquired startup, the payments should have ceased upon the death of the shareholder, or at least been routed to the estate's holding account. Instead, the funds were being pushed directly into his personal checking via an automated clearinghouse transfer. I asked her to trace the origin routing number. I assumed it would lead to a corporate treasury account at a major bank. It did not. The routing number belonged to a regional credit union in Delaware. The account was registered to a limited liability company called Meridian Logistics Consulting. I had never heard of Meridian. My father had never mentioned it. I asked Sarah to pull the corporate registry files from the Delaware Division of Corporations. The filing was sparse. Meridian Logistics Consulting was formed in September 1998. It had no website, no digital footprint, and no listed employees. Its registered agent was a standard corporate service provider in Wilmington. But the most concerning detail was the management structure. The operating agreement listed a single managing member. It was not my father. It was a man named Richard Vance. I recognized the name immediately. Richard Vance was the former chief executive officer of the pharmaceutical distributor where my father had worked. Vance had retired abruptly in 1999, citing health reasons. 2. Understand the relationship between my father and Vance, we had to look at the tax treatment of the stipend. This is where the forensic investigation shifted from a simple asset trace to a complex behavioral analysis. Looking back at the 1998 through 2005 tax filings, there were three distinct anomalies in how this income was reported. I am curious which red flag you would have caught first. Comment 1, 2, or 3 below as we walk through them. First, the $4,500 was reported on a 1099 MISC form as non-employee compensation. Second, my father never filed a Schedule C to deduct business expenses against this income. Third, he paid the self-employment tax on it out of pocket, absorbing a 15% penalty rather than structuring it as a passive dividend. In forensic accounting, this pattern is often indicative of a structured settlement mask. It is a method used to disguise hush money or non-compete payouts as standard consulting fees, shifting the tax burden to the recipient to maintain the illusion of a legitimate business relationship. I needed to know what my father was consulting on. And more importantly, I needed to know why a former CEO was paying a mid-level supply chain director $54,000 a year for 2.5 decades. We initiated a civil discovery process. Because Meridian Logistics was an active entity still disbursing funds to the estate, we had the legal standing to subpoena its internal financial records and operating agreements. The documents arrived in a sealed box 3 weeks later. Inside, beneath layers of boilerplate corporate filings, was a single, notarized agreement dated October 12, 1998. It was a non-prosecution, indemnification, and confidentiality agreement. I read through the dense legal terminology, my understanding of my family's history fracturing with every paragraph. The document detailed an internal audit conducted by the pharmaceutical distributor in the summer of 1998. The audit had uncovered a severe discrepancy in the company's pension fund. $4.2 million had been systematically diverted through fraudulent vendor invoices. The authorization codes for those invoices belonged to the supply chain director, my father. But the addendum to the agreement told the actual story. My father had not initiated the diversion. He had merely provided the clearance codes to Richard Vance, the CEO, who was siphoning the funds to cover margin calls on his personal leveraged portfolio. When the internal auditors closed in, Vance faced federal charges for embezzlement and ERISA violations. He offered my father a choice. My father could cooperate with the federal investigators, send Vance to prison, and likely face termination and secondary charges for his negligent complicity. Or, he could take the administrative fall. The agreement stipulated that my father would accept full responsibility for the administrative oversight, resign quietly, and sign a lifelong non-disclosure agreement. In exchange, Vance would not face criminal referral from the company board. And to ensure my father's silence and his family's stability, Vance established Meridian Logistics. The $4,500 a month was not a dividend. It was a structured payout from the stolen pension funds, laundered through a shell company, designed to look like a consulting fee. My father had sold his professional reputation and absorbed the quiet shame of a forced resignation to secure our futures. He never complained. He never displayed the physiological markers of stress. He simply went to work the next day at a lower-paying job, drove his 10-year-old sedan, and ensured the stipend was allocated to our tuition and mortgages. The confrontation with this reality was not loud. There were no dramatic arguments among my siblings. There was only the cold, procedural reality of the law. We consulted a white-collar defense attorney to understand our liability. The legal reality was complex. The funds we had received were, technically, the proceeds of a crime. However, the attorney explained that the statute of limitations for the underlying embezzlement had expired decades ago. Furthermore, the IRS has a 6-year statute of limitations for civil tax fraud, which had also long passed. We were not legally required to return the money to the defrauded pension fund, which had since been absorbed by the PBGC. The money was ours. But the moral architecture of our lives had been fundamentally altered. Every degree we held, every property we owned, was subsidized by the systematic looting of a worker pension fund, facilitated by our father's silence. In family business law, there is a concept called the clean hands doctrine. It suggests that a party seeking equitable relief must not have acted unethically in relation to the subject of the complaint. We had not committed the crime, but we had spent the proceeds with our eyes closed. My brother, the physician, quietly liquidated a portion of his investment portfolio and made an anonymous donation to a financial literacy nonprofit, an attempt to balance a ledger that could not be legally reconciled. My sister refused to discuss it, compartmentalizing the funds as a standard inheritance. As for me, I was left to close the estate. I had to decide what to do with Meridian Logistics. The LLC was still active. The operating account still held a balance of roughly $40,000. This brings me back to the insight I teased at the beginning of this audit. We often judge willful blindness as a moral failing. We assume that if we do not ask where the money comes from, we are complicit in its origin. But when the alternative is the financial ruin of your children, the prefrontal cortex overrides the moral imperative. My father's willful blindness was not born of greed. It was a calculated, biological sacrifice. He absorbed the cognitive dissonance so that we would not have to. He carried the weight of the secret so that we could carry the weight of our degrees and our mortgages. I filed the final paperwork to dissolve Meridian Logistics. I transferred the remaining $40,000 to the estate's residual account, to be divided equally among the three of us. I closed the file. I believed the audit was complete. But forensic accounting is a discipline of absolute finality, and the ledger rarely balances on the first attempt. 2 days ago, Sarah, the lead accountant, sent me a final, encrypted email. She had been reconciling the final bank statements for the estate's holding account. She noticed a discrepancy in the timeline of the ACH transfers. Richard Vance, the former CEO and the sole member of Meridian Logistics, died of pancreatic cancer in August of 2019. His estate went through probate, and his assets were distributed to his heirs. Meridian Logistics was not listed in his probate filings. According to the state registry, the LLC was administratively dissolved in December 2019 for failure to file an annual report. Yet, the $4,500 monthly deposits into my father's account did not stop in 2019. They paused for exactly 3 months, and then resumed in March of 2020. They continued through the pandemic. They continued until my father's death last October. If the LLC was dissolved, and the sole member was deceased, the operating account should have been frozen. The authorization for the ACH transfers should have been revoked. Sarah pulled the final transaction metadata from the credit union. The deposits that cleared between 2020 and 2023 were not originating from the dissolved Meridian account. They were originating from a different routing number. A trust account registered in Nevada. I looked at the name on the trust. It was not Richard Vance. It was not my father. The trust was established in 1998, the exact same month the embezzlement was discovered. And the authorized trustee listed on the account is someone who was only 12 years old when the non-prosecution agreement was signed. The ledger is not closed. The stipend was never just about Richard Vance. And the person who has been funding our lives for the last 4 years is still out there, waiting for the estate to finally ask them who they are.